Donald Trump has fired the opening salvo of his trade war, imposing tariffs on China on Tuesday that sparked instant retaliation from Beijing amid fears for the global economic repercussions. Moments after US tariffs of 10% came into effect, China swiftly announced an antitrust investigation into Google. China's finance ministry also announced 15% tariffs on coal and liquefied natural gas, and 10% on crude oil, farm equipment, large displacement vehicles, and pickup trucks from the US. China's Commerce Ministry and its Customs Administration said on Tuesday that to safeguard national security interests, the country was imposing export controls on a raft of critical minerals: tungsten, tellurium, ruthenium, molybdenum, and ruthenium-related items. The Commerce Ministry also said it was adding the US companies PVH Group and Illumina Inc. to its unreliable entity list, opening them to restrictions or penalties without detailing what the companies were accused of. PVH is a clothing company which owns brands including Tommy Hilfiger and Calvin Klein. Illumina is a biotech firm specializing in genomic sequencing, which recently partnered with NVIDIA on health-related AI tech. The unilateral imposition of tariffs by the US seriously violates the rules of the World Trade Organization, China's finance ministry said in its statement announcing the retaliatory tariff. It is not only unhelpful in solving its own problems, but also damages the normal economic and trade cooperation between China and the US. Earlier, the US president pulled back from the brink of an economic conflict with Canada and Mexico, however, delaying threatened duties for another month following 11th-hour talks. For exports from China, the US has scrapped an exemption through which shipments valued at less than $800 have not faced tariffs. Popular Chinese retailers such as Shein and Temu have relied on the exemption to sell cheap goods in the US. Following a call with Mexico's President Claudia Sheinbaum on Monday, Trump agreed to postpone tariffs of 25% on Mexico, the latest of several delays, after she offered to send 10,000 of the country's troops to its border with the US. Talks with Justin Trudeau, the Canadian Prime Minister, also prompted Trump to postpone 25% tariffs on the country. Canada is implementing a $1.3 billion border plan, Trudeau said, and will appoint a fentanyl czar, list cartels as terrorists, and ensure 24/7 eyes on the border. As the US readied higher tariffs on China on Monday, the White House announced that Trump would speak with China's President Xi Jinping later this week. Beijing earlier pledged to hit back with countermeasures and file a legal case against the US at the World Trade Organization. Economists have warned Trump's tariff plans risk raising prices for millions of Americans just weeks after he pledged, upon taking office, to rapidly bring them down. But addressing reporters in the Oval Office on Monday, Trump maintained that tariffs were a very powerful means of both strengthening the US economically and getting everything else you want. Every country wants to agree on a way to avoid US tariffs, the president claimed. In all cases, they all want to make deals. Trump had conceded over the weekend that they could cause a little pain in the US. Will there be some pain? Yes, maybe, and maybe not, he wrote on social media. But we will make America great again, and it will all be worth the price that must be paid. The bigger surprise for many analysts is the probe into Google. China's State Administration for Market Regulation, SAMR, announced it will investigate Google's business operations for possible antitrust violations. So far, details are limited, but sources suggest Beijing is focusing on how Google's search engine and digital ad tools operate internationally. This might expand to include Google's Android ecosystem or data collection practices. Observers see the move as a direct shot at a US tech leader. Historically, China kept Google services behind the Great Firewall, limiting their presence within mainland China. So it's not about domestic market share. Instead, it might be about challenging Google's global influence or pressuring its partners in Asia. Some also point to how the US government restricted Chinese tech firms like Huawei and ZTE. Beijing might be using a similar playbook to hamper an iconic American company's global ambitions. From a legal angle, this mirrors what US and EU regulators have done with major tech firms investigating them for anti-competitive behavior. Now China is applying that approach to an American giant. A bar chart from TechReg Insight shows an uptick in Chinese investigations into foreign firms since 2022, suggesting that Beijing is more willing to use regulatory powers to shape the global tech landscape. Why combine tariffs with a Google probe? Analysts see it as a dual-pronged strategy. First, the tariffs are the classic tit-for-tat response to new US levies. China wants to show it won't be bullied, especially when facing economic pressure. Second, the Google investigation signals that Beijing won't hesitate to target leading American tech brands, especially if Washington continues blacklisting Chinese companies. This approach resonates with a broader theme. China is determined to control its tech future and reduce reliance on Western software or hardware. Launching a high-profile inquiry into Google showcases Beijing's regulatory might. If the US punishes Chinese firms abroad, China can do the same to US giants. Yet experts caution there's risk. If Google feels threatened, it might reduce collaboration with Chinese technology partners or fight back legally. American lawmakers could retaliate with fresh restrictions on Chinese apps or revisit calls to ban certain Chinese social media platforms in the US. The tension could escalate, overshadowing any near-term trade talks. The agricultural sector may bear the brunt of these new tariffs. Since 2018, US farm exports to China slumped. Soybean sales dropped 30% in some years, though partial deals later helped. Now, with corn and wheat on the target list, farmers worry about more unsold inventory. A spokesman for the American Soybean Association told reporters they're nearing a breaking point. If Beijing sources from Brazil or Argentina, some American farms may not survive another hit. The tech industry also stands on edge. While Google's direct presence in China is limited, it partners with hardware makers that manufacture devices in Asia. If regulators clamp down on Android licensing or data sharing practices, supply chains might shift. Meanwhile, other big firms like Apple, Microsoft, and Amazon brace for the possibility that they too could become targets if US-China friction keeps rising. A line graph from the US Department of Commerce shows that tech hardware exports to China hovered around $60 billion annually before trade tensions flared. After the first wave of tariffs, they dipped to under $50 billion. Now they risk sliding further if Beijing intensifies its scrutiny of American tech across the board. Wall Street took an immediate hit after China's announcement. The Dow Jones slid 2% in one session, while the Nasdaq fell 2.5%. Tech stocks, especially those reliant on global markets, faced heavier losses. Google's parent company, Alphabet, dropped 3% on the day of the news amid investor fears that a prolonged investigation could hamper aid revenues or lead to global boycotts. Chinese markets also dipped slightly, reflecting worries about a drawn-out trade war. But some Chinese tech firms, including local search engine providers and e-commerce giants, saw minor gains. They might view a crackdown on Google as a chance to capture more international market share. A bar chart from Shanghai's main stock index shows a 1.2% rise in shares of domestic web service companies following the probe announcement. The White House criticized China's actions, calling them unproductive and politically motivated. A presidential statement insisted these tariffs will only harm Chinese consumers and businesses. Meanwhile, it doubled down on the claim that China must address structural issues, like forced tech transfers and intellectual property theft. US trade officials threatened additional tariffs or export controls if Beijing doesn't back off. Google said it plans to cooperate fully with any legitimate regulatory inquiry, but questioned the timing and scope of China's move. A company spokesperson told tech reporters they see no basis for an antitrust case in a market where Google is mostly blocked anyway. They suspect the probe might be a bargaining chip in trade talks. Critics say the same about how the US used security claims to restrict Huawei. For years, analysts have warned of a potential US-China decoupling, where the two largest economies separate supply chains, financial ties, and technology standards. These new tariffs and the Google probe fuel that narrative. China invests in local chip production to reduce dependence on US suppliers. The US invests in onshoring or nearshoring manufacturing in Mexico or other allies. Both superpowers appear to want more self-reliance. The tech sphere is the biggest fault line. If Google is effectively kept out of China, American software might lose future opportunities in the world's biggest internet market. Meanwhile, Chinese companies keep expanding overseas, especially in emerging markets. A map from TechFlow data shows that Chinese smartphone brands like Xiaomi or Vivo hold significant shares across Southeast Asia, Africa, and parts of Europe. By contrast, Google's main monetized services, search ads, YouTube, don't operate freely in China. That's a huge chunk of global internet users off-limits to American platforms. Another area potentially hit is electric vehicles, EVs, and green technology. The US and China lead in EV battery production, but they also rely on each other for various components. If tariffs keep rising, it may become more expensive to import or export EV parts. That could slow the push toward cleaner cars in both countries. Also, big tech players like Google invest in cloud computing for self-driving vehicles or smart city infrastructure. If the investigation disrupts Google's Asia partnerships, it might hamper future EV collaborations that rely on Google's software. Meanwhile, Chinese EV makers like BYD or XPeng see less competition from American tech. This interplay of tariffs, digital policy, and automotive trends underscores how broad the conflict is becoming. Some scenarios for the coming months: quick de-escalation. The US and China meet for a high-level talk. The US modifies some tariffs. China suspends the Google probe. Both sides claim victory, but trust remains shaky. Extended stalemate tariffs stay. The Google investigation drags on. Companies adapt by shifting supply chains or focusing on other markets. Consumers pay higher prices, but no meltdown occurs. Full-blown escalation. The US imposes even more duties on Chinese tech. China expands its antitrust crackdown to other American giants. Global trade slows, stock market slump, WTO or global court. The conflict heads to the World Trade Organization. However, the WTO's power is limited and big players often ignore rulings. The row drags out for years. At this point, none of these paths can be ruled out. Both sides appear determined, fueled by domestic political pressures and a belief that their position is right. American hawks argue tough tactics are necessary to contain China's rise. Chinese leaders say they must defend national sovereignty. US allies in Europe or Asia might quietly cheer the US stance on trade or technology, but worry about economic fallout. Countries like Germany or Japan rely on stable global supply chains. If the US and China keep fighting, everyone could face rising costs. Meanwhile, BRICS nations, Brazil, Russia, India, China, and South Africa might see an opening. If the US stumbles, China could lead a more extensive trading bloc with emerging powers, promoting alternatives to American-led systems. Investors in emerging markets also watch carefully. In 2022, global FDI, foreign direct investment flows, shifted, with more money heading to places like Southeast Asia, away from friction between the US and China. If these tensions worsen, that trend might intensify, reshaping the economic map. For everyday people, the conflict's effects are real. Higher tariffs mean pricier gadgets, clothing, or groceries. American farmers lose a vital export market, risking bankruptcies in rural areas. Chinese manufacturers might see reduced US orders, leading to factory layoffs. The uncertain environment also slows new tech partnerships. Some startups might scrap cross-border deals, stunting innovation. Consumers wanting cheaper electronics or produce face-limited choices. Companies from Walmart to Apple have warned that tariffs can push up retail prices. This is especially tough when inflation already looms. Meanwhile, small businesses in the US reliant on Chinese parts or in China reliant on US apps might close if the war intensifies. The broader economy can't thrive in endless trade tension. Yet there's a twist. Rumors suggest China may not stop at Google. Insiders hint that other American tech giants could be next in Beijing's crosshairs if the US doesn't back down on tariffs. If that happens, we might witness a tectonic shift in how the digital world functions, with American and Chinese tech ecosystems splitting further. Will the White House step in to defuse the situation, or is this just the opening salvo in a far bigger battle for global tech supremacy? The coming weeks could reveal whether these tensions calm or explode into a new frontier of economic warfare.